Well, good morning, John. Good to see you this Thursday morning. A bit rainy in Sydney, but we have something to celebrate, I guess. The Reserve Bank on Tuesday cut interest rates to 3.85. John, was this rate cut a dovish cut, and was it justified? Should it have been 50 basis points? And what does it mean for the share market and the economy?
Well, I think you can say the Reserve Bank was fairly sanguine about the outlook for Australia in terms of growth, fairly positive on the outlook for inflation, and probably a bit concerned about the tariff issue, which is unresolved. They gave that as their reasons for cutting interest rates and considering a larger cut. I think what we can take out of the consideration of a larger cut, Paul, is there's going to be another cut fairly quickly, because you can't say you were thinking about it and then you stop at 0.25. So there's probably another cut coming, which gets us down to 3.6-ish. Is that enough? Well, it's going to be interesting because just looking at America, and their cash rates are fairly solid, above 4%, and no sign of movement yet from the Federal Reserve. So it does put a bit of a curveball on what the Australian Central Bank can do. They'd be very happy that the Australian dollar is holding above 64 in the face of that interest rate cut, because their biggest risk is inflation coming from overseas on a weak Australian dollar. Whether they're too bullish on the inflation outlook, time will tell. I think they're getting a free kick with the oil price, which is Trump-induced. They're probably getting some free kicks from China, deflating and exporting aggressively out around America, although that'll probably be stalled somewhat in the next quarter because American importers are aggressively importing again, Paul. So it's just something to think about before the next tariff round. And the outlook for Australia's growth is a little bit of a worry.
So a lot of people are expecting, a range of rate cuts over the course of the next 6-9 months. What's your view on where the terminal rate will be? So where does it end up? Does it end up at 3.1 or maybe 3.35 if there are 2 or 3 cuts more? I watched Michelle Bullock in her press conference, and she did speak about the roller coaster of the Trump administration's tariff movement. So there's a lot of uncertainty still that the market's trying to deal with. But what's your view on the terminal rate?
I think we're heading to the low threes. Is it justified? For part of the community who are geared into property, it is. They are under immense pressure, no matter how you look at it. And we have government policies again to stimulate the price of property, to make it even more expensive for people to buy into. That's a crazy situation and shows a lack of leadership and national policy. The roller coaster is a fair comment. We'll be publishing our letter to investors and doing a roadshow around Australia, Perth and Melbourne, Brisbane coming up, and then Sydney. So please look out for that on our website and book in. But Perth is next week. But we will be handing out our letter to investors and publishing it. Our view is that tariffs in America are going to settle around the 10% generally, a little bit more for China, subject to negotiation. And the issue that throws up is elevated inflation in America, potential for economic slowdown in America. So is that a form of stagflation? Interest rates, therefore, in America, as I said in the first question, holding well above Australia, putting pressure on the RBA to not cut too aggressively, because they'll open up a big margin and have a short-term effect on the Aussie dollar. It is a very scrambled outlook, and I appreciate what the governor said. I think the Trump administration is really making it difficult for other central banks. Now, you can either take the view of Europe and just go your own way and just cut interest rates and say, look, we're not interested in what America does. And that's been pretty much their view for a decade now, so that doesn't change. Japan runs its own boat. China runs its own boat. The question is, can Australia run its own boat? But I think she's hamstrung because the property market and the debt in the property market is too excessive. That's what's crueling her monetary policy.
But it seems like we're stuck in this low growth zone. Historically, over the last 40, 50 years, Australia's managed to grow close to 3% per annum. We're now talking about, reaching for perhaps 1.5, 1.8. Employment's been pretty strong, but are you seeing signs of weakness in the consumer, business investment and so on?
I don't think we're seeing that. I think it's an interesting dilemma. We've got a lot of people immigrated. We've grown the population. We've grown the workforce. A lot of unskilled jobs are being filled and service jobs are being filled. They're not big salaries, but they consume. So that's holding consumption up, more so on non-discretionary than discretionary. So there's an interesting story around that. In terms of economic growth, we've got more people working, but productivity, I won't say it's collapsing, but it's declined dramatically since COVID. And there's no national policy. Now, the Treasurer has come out and said his biggest target, he didn't want to do it a 3-year target, he wanted to make it a 6-year target, which is ambitious, to get productivity moving upwards. So what we're having is increased labour, increased hours work, lower productivity, coming out at what you say, 1.5% GDP. What we need to get is higher employment, better productivity, multiplying into 3% GDP. So I think that what we're seeing, Paul, is the decline in productivity of the Australian workforce, and there's a whole lot of reasons there. It was a very short-term political debate in the election campaign. It wasn't really discussed, but there is an undercurrent to the Australian economy where the labour force is underproducing. Sections are underproducing, and we're very much services, and it's very hard to put real numbers on service production because it doesn't produce anything, it services a need. So Australia's caught somewhat, and it goes back to my constant comment, there's no vision here. It's just rolling and rolling, and it's chaos.
Before we leave Australia, it's interesting that after the election, there's been a flurry of commentary in the Australian Financial Review and the Australian and some other newspapers about the risks of the new superannuation taxation proposals. And I saw you were quoted, John, in an article in, I think it was the Australian, quite prominently. It's all very well. Now that the election's over and the government's got a mandate to implement its policies, do you have any further comment about that superannuation proposal? Is this going to hurt the share market and hurt individual superannuants?
Well, it's funny when we talk about mandates because the government put it to the Parliament prior to the election and lost the vote. They didn't go back to the people, even though they kept it in the background as a policy change and it was adopted in the budget, in the forward estimates. So, is that really the way you say you have a mandate, that you put it in a budget estimates paper and say, well, the public voted for it because they voted through our budget? I think that's being a bit cute. The big issue is, I don't think there's any, I'll put it this way, I don't think there's much argument that something has to be done about big balances in super and the tax advantages which have been created, and it's been created over 20 years with the greatest respect to both sides of Parliament. And you have to go right back to Costello's changes where he encouraged aggressively a lot of money to go into super without thinking about the consequences. But then again, he grandfathered the defined benefits for politicians, including himself, without thinking about the consequences of that. So there's a lot of issues here. However, I think the general consensus, and there are a few outliers where I think of people that are just talking political nonsense, unrealised capital gains tax is an outrageous tax, very unfair, very un-Australian. We're not a third world country. We're not that desperate for tax collections. There are better ways to collect tax. I can come up with 3 or 4 off the top of my head. very quickly, certainly around speculation, and money just flowing all over the place and doing nothing. Much better way to tax than retrospective unrealised capital gains tax. Complete outrageous. Australia needs to have a proper tax policy, a proper superannuation policy, start bringing fairness back into every discussion, and start bringing a vision. Without those elements, we get this quagmire debate, and that's where we are. And it's very disappointing. I don't know what foreigners think when they look at us about when we have these sort of taxation changes, and they must look at us and go, well, it really does present as a country which doesn't actually have a plan.
In the meantime, despite the roller coaster on the global scene, share markets have strongly recovered since mid-April, and I saw in Goldman Sachs's data this morning, apparently the Australian share market is now on an 18.9 price earnings multiple, prospective multiple. It makes it very expensive. And
it is very expensive, and I just caution everyone, we're a diversified investor, and we advise our clients to be spread. And I'm on the record for the last 6 or so months saying, look, I think it's time to think about yield over capital gain. And when you get rallies like this, which are really knee-jerk rallies, and as you say, the American market's almost recovered. And I put the word "almost recovered" is the telling phrase. As we know, as we speak, the American market had a pretty bad night last night, and bond yields went up. I think equity valuations are hitting ceilings. So rather than, and I don't think they're going to burst through, I think they're going to bounce off ceilings, which means hit a ceiling, pull back, try and make it again, pull back. And I think we're in that sort of sideways movement now that recovery has occurred. Now, what can go wrong is the tariff negotiation gets out of control, and the bond market of America, which is showing signs of worry, Paul. I mean, we comment on this every week, you do. 10-year bond in America, 4.6, and 20 and 30-year bonds above 5%. The cost of debt to the American government is beginning to grow exponentially as debt is rolled. Big issue. American deficit, as we know, $2 trillion. Trump trying to raise money through tariffs. And we're all trying to see where this settles. But tariffs are going to create inflation. They may create 200, 300 billion of revenue, but it's effectively a GST on American consumers. They're the ones paying. The whole debate around this is quite bizarre. You might as well just put a GST on everything rather than hammering China and other emerging economies with their imports, in Canada and Mexico, his neighbours. But he hasn't done that. He's dragging everyone into the White House for inane debates, and he had one yesterday with South Africa, which is an interesting dialogue, but we won't go there. I don't believe South Africa was there offering much in terms of trade, but anyway, good luck to them. So, getting back to the commentary, we are in an elevated equity market, and I think the American market is going to be challenged by the risk-free rate of return. But as I say, and I will say this next week and the week after in my presentations, I think we're looking down the barrel of quantitative easing coming back in America. All roads lead to that. The American government needs to get bond yields down. And if bond yields are scared by inflation, and they should be scared by inflation with tariffs coming on, then they've got an almighty issue to address, and it can only be addressed through a quantitative easing program. So, and that throws a spanner into everything I just said, because where do equity values go when you're printing money? And the history says they get more elevated. So it's a pretty precarious situation, suggesting caution, good diversification, a focus on yield and cash flows in your investments. But besides that is this ridiculous tax on unrealised gains. As we said last week, Paul, and I reiterate again, people who believe they're going to be exposed to unrealised tax need to address how they're invested and go for more income anyway. Put more income and less capital gain there. And Australian private credit markets and corporate debt markets are still showing 6, 7, 8% returns, depending on what sort of risk you want to take in. So that's a pretty reasonable return with inflation around 2.5% in Australia.
So really the key outtake is a focus on sustainable, high quality yield, be diversified, and I guess
Be
those.
cautious.
Yeah.
Be cautious and don't be and excessively optimistic. And our job every week, Paul, as we talk, is to grind through what's happened and what's happening. And you get a period where it's a hiatus like we've got now, where you've got this 90-day truce, if that's the word, between America and China. I can tell you, and I'm on some trading boards who import, and it's worth our viewers and clients understanding this. China manufacturing and ports were closed. American importers refused to take orders or put orders on. Now they're rushing to put orders on and get supply in the next 90 days. And if you're a little Australian importer, the result is this, that we've kept our orders in place with warehouses and manufacturers in China, and they've just said, look, sorry guys, you're small beer for us. We're going to push you back 3 or 4 months.
Yeah.
So that's the effect on some importers out of China and Vietnam and Cambodia, places like that. We're a small player, and America is whiplashing the supply lines. So there are ramifications for that. So we just have to watch that. So, importers looking to get their supplies in for Christmas would have felt comfortable a couple of weeks ago, are now feeling a little bit more uncomfortable in terms of can they get supply out of China as the Americans swamp that market.
All right, we'll have to end it there, John. Interesting as always. Thank you so much, and we'll see you next week.
Thanks.